New York University Stern School of Business. He is also CEO of Roubini Macro Associate, a co-founder of Rosa Roubini Associate, based out in London. Nouriel is, I cannot see, long time no see, because I see you 6 months ago, but it's very nice to see you again. Nouriel, please go ahead.
Thank you, Carlo. Great pleasure being back and being able to present my views about the global economic outlook. I'll take a broad perspective. And I think that there is an ongoing debate, of course, on what's going to be the shape of this economic recovery. Markets are now pricing in a V-shaped recovery with strong growth well above potential for the United States and many other parts of the world. We'll see what the IMF comes with its forecast next week. Some people worry about the more anemic recovery, something more like U-shaped, given a bunch of downside tail risk. And there's even a risk of a double-dip recession, like the one that is experienced now by the Europe and the Eurozone, where growth in the fourth quarter and first quarter looks like negative. To understand what's going to happen this year and next, we have to do a retrospective of what happened last year, briefly. Last year, in the first half of the year, we had the free fall. It was like an eye. Demand, supply, employment, export, imports, consumption, investment were in free fall because we shut down through a policy-induced coma the global economy to try to stop the spread of the contagion and to flatten the curve. So it was a free fall for 2 quarters. Then as we reopened, now we know too fast, too soon, there was a V-shaped recovery in the third quarter. Say, in the US, growth in the third quarter was annualized 33%. But after the free fall in the first half, it was easy to grow very fast, well above trend for at least 1 quarter. And then by the fourth quarter, we saw a return to the spread of the contagion. Second kind of wave in Europe, a third wave in the United States, and either lockdowns or the risk aversion of the private sector led to a sharp slowdown of economic activity. US growth in the fourth quarter was only 4%, was negative in most of Europe and the Eurozone, and the first quarter for the Eurozone looks still like a W. US is picking up, but still not very robust growth like the third quarter. Now, financial markets are now discounting this, what happened in the fourth quarter and the first quarter of this year. They're talking about a temporary soft patch or a temporary pothole, and they argue that the recovery is going to be strong, V-shaped, because we're going to be now successfully controlling the spread of the contagion, because we're going to have massive distribution of vaccines, because we're going to have better weather in the northern hemisphere, because the contagion will be less when the weather is warmer, and we still have massive loose monetary, fiscal, and credit policies. And in spite of the recent rise in long-term interest rates in the US around the world, financial conditions by any standard remain very easy. So they're discounting the soft patch and the pothole and saying we'll have a strong recovery. Now, whether the recovery is going to be V, like the baseline of most analysts, or a more anemic U, or whether there is going to be even a risk of a double-dip recession, depends on a variety of factors and upside and downside risk I want to cover. Some of them are short-term, some of them are medium-term. Question number 1, are we going to be in a world in which there are new strains of the virus and repeated stop-and-go cycles, because we stop when the virus spread and then the political pressure to reopen leads to go, and then the virus spreads again, and then we have another stop, and we've seen this stop-and-go in US and Europe already 2 or 3 times. So are we going to be in that world, or are we going to be in a world in which there'll be successful now containment of the virus on a more persistent basis? We're seeing new strains in the United Kingdom spreading to Europe, in Brazil, in South Africa. But we're also seeing the drop in cases very sharply in the US and in China and parts of Asia. So that's the first question. Second question, are we going to have a slow distribution of the vaccine? And are we going to have vaccine-resistant strains of the virus? Or whether we're going to be able to accelerate the rate of vaccination in a successful way and achieve herd immunity by sometime later this year. Again, there is differentiation. Some countries like US and UK, Israel, and some in Asia seem to be more successful in vaccinating. The data from European Union and many emerging markets is much weaker. Third question, are we going to have a risk of a permanent scarring and hysteresis effects? Because temporary unemployment leads to permanent employment if you stay unemployed for long enough and you lose skills, human capital, and you have stigma. Are we going to have that permanent scarring and hysteresis, or are we going to avoid that if the recovery is early and robust so that scarring and hysteresis doesn't occur. Again, that depends on the countries. 4, are we going to have deleveraging by highly indebted households, firms, and some governments in emerging markets, as opposed to the pent-up demand is going to be released when economic activity recovers and the spread of the contagion is successfully achieved and we have vaccination? 5, are we going to have continued rise of income and wealth inequality that leads to social political instability, but also to depress aggregate demand as we redistribute income from those who spend more to those who spend less and save more, from household to corporates, from poor to rich, and from wages to profits? Or are we going to have now more progressive policies addressing this income and social inequality that has both economic effect and social political ones? So those are 5 factors in the short run. There are also 4 medium-term factors that I think are important. Are we going to go in the world of greater deglobalization and protectionism and inward-oriented policy, or are we going to be successful in controlling these protectionist policies over time? Second question, are we going to have a Cold War between US and China is going to become colder, leading to radical decoupling, or are we going to be able to manage the strategic competition between US and China and have competition on some dimensions and cooperation on other ones? 3, will tech innovation stall given the US-China decoupling and a backlash against big tech, or there'll be acceleration of these technology and innovation that increase potential growth as there is more innovation over time? And 4, will political risk like populism and geopolitical risk like strategic rivalry between US, China, but also between US and Iran, North Korea and Russia escalate, or are going to be contained over time and not? Now, these are all the 10 factors that are going to affect the shape of the recovery, and it's clear that the recovery is going to be uneven and differentiated, both within advanced economies and emerging markets and across different regions. As of now, US looks good, China and most of Asia, EM looks good in terms of having a greater V-shaped recovery, but as of now, in Europe, things look much more fragile, and of course, in a number of emerging markets, not all of them, but outside of emerging Asia, things look very difficult. I think the World Bank referred to this crisis as being a pandemic depression, not just a pandemic recession for some countries that are quite fragile. So it's a mixed bag. The good news might be that strong growth in US and China could lift global growth, but there are many other parts of the world that are fragile. Now, one key issue, of course, that has been debated is the question about whether the stimulus is excessive and whether it's going to be a rise of inflation. It's going to put in trouble central banks that they'll have either to accommodate it or fight it and then have another recession. In the short run, of course, we still have slack in goods market, slack in labor market with unemployment well above Nairo, slack in commodity prices that fell and recovered partially, and some slack in some real estate markets. And all the liquidity has gone more into asset inflation rather than goods and service inflation. There are good reasons to think that inflation may return over the medium term, not this year, but in the prospect of the next 2 or 3 years, but also good reasons why inflation may remain contained. And of course, the answer to that question is key for financial markets, because if inflation were to rise and then central banks have to fight it, there will be a risk of a severe correction of risky assets like US and global equity. The arguments for greater inflation over the medium term is that we're going to see supply bottlenecks, especially as there is reshoring of global supply chains and other bottlenecks at a time where demand is going to be recovering. That's a problem. Secondly, we still have large monetized fiscal deficits, and eventually large monetized fiscal deficit can lead to overheating and to inflation. And that risk is greater if we're going to have negative supply shocks in the global economy over the medium term. And the negative supply shocks that may reduce potential growth and increase inflation include deglobalization and protectionism, aging that leads to a reduction in the supply of labor, decoupling between US and China, and less tech innovation that can push inflation higher. In the 1970s, those negative supply shocks were the oil shock. This time around could be protectionism, decoupling, aging, and others. So those are the kind of things that you have to worry about. And they could lead actually not just to inflation, but also to stagflation like the 70s. Moreover, central banks might be today into a situation of fiscal dominance, given the high level of private and public debt, they may become less independent and less willing to fight inflation when inflation rises. Moreover, COVID has led today to a rise in private savings and a wall of liquidity and a collapse of velocity. But when things are going to normalize, you could get these savings and a strong recovery of growth. You could have a rise of velocity that then leads to credit creation that becomes inflationary. And finally, the role of China in global disinflation in the last 2 decades may reverse, as China now is aging, and therefore the impulse coming from China for disinflation is not as much. Those are the risks of inflation over time. What could keep inflation low in spite of that? First of all, $1.9 trillion fiscal stimulus looks like huge, but some studies suggest that only a third is going to be spent. The most is going to be saved, as many households are in arrears on their rents, on their utilities. They have to pay back their mortgages, their credit cards, student loans. If the growth impulse is smaller because only part of it is spent and most of it is saved, then growth is less, inflation rises more slowly, and the pressure upward on long-term interest rates is going to be smaller, as those savings that are reducing debts are going to be recycled in bond markets. Secondly, some studies suggest that globalization had only a modest role in the disinflation of the last 2 decades. So some degree of deglobalization is not going to be inflationary. 3, demographic in the US may lead to a lower NIRO, as old people decide to stay in the labor market and work longer and provide a supply of labor, and that contains, again, inflation. 4, the Fed may be able to resist the rise in inflation and keep its credibility and its independence, fighting inflation soon enough, exiting zero policy rates and QE when necessary. Additional factor, the neutral interest rate, the R star, may go higher if we have aging that leads to these savings. And if these savings leads to stronger growth of demand, that would allow central banks to achieve their inflation targets sooner, and therefore not to stay in those unconventional monetary policies for too long. 6th factor, technological innovation may continue and lead to positive deflation, increase in potential growth, reduction of cost of production. And finally, aging reduces savings, but it also reduces investment and therefore aggregate demand. So I think the jury is still out. I think in the short run, we are going to see deflation or lowflation and still low inflationary pressure. Of course, if we have a very large continued monetized fiscal deficits, and we're going to have some of those negative supply shocks that I worry about, eventually inflation is going to come back, and not just inflation, the risk is stagflation, rising inflation and recession. And that will be a nightmare for central banks like it happened in the 1970s. Thank you.
Thank you very much, Nouriel. I was actually